Hi, it's Kristi Sullivan with Sullivan Financial Planning. Thanks for tuning into my video. Today's video is accompanying a short blog that I wrote trying to clear up some misconceptions that I hear a lot about selling your primary residence and what kind of tax you might face when you make a profit. A lot of people at this point have made a lot of money on their homes and are concerned that if they move, especially seniors who would like to downsize and down price in some cases, what are the rules around the income taxes that they will pay for selling their house. And so the first rule that I want to clear up is it's not income tax. You will pay capital gains tax on the profit of your house, but you do get a break on that. And this is all discussed in the blog, so I won't repeat that part. But what I wanted to do is give you a bit of an example of how that works, because I think a lot of people don't even really understand what capital gains tax rates are as compared to income tax brackets. So capital gains tax rates are different if you're talking about long-term capital gains. Long-term capital gains means you've owned an investment, might be a stock, might be a home, some kind of investment for over a year. At that point, any profits that you make from selling that asset are taxed at long-term capital gains rates. Long-term capital gains rates are either 0%, 15%, or 20%, depending on your income. And I won't go into all that. You can look up the income brackets for capital gains rates on nerdwallet.com or aarp.com or the irs.gov website. But just know that even though the highest income tax bracket is around 37%, the highest capital gains tax rate is only 20%, again, depending on your income. So long-term capital gains is a lower tax rate than regular income taxes. Also, when we're talking about selling your primary residence, and I mentioned in the blog, a $250,000 tax-free profit that you can get if you're single, $500,000 if you're married filing jointly. So what happens if you sell a house, you're married, and you've made $650,000 profit on the house? Well, then the first $500,000 of it you get tax-free, but the next $150,000 you need to count for long-term capital gains tax purposes. So again, depending on your income, that could be either 0%, 15% is the most likely, or it could be 20% of the $150,000 that you would pay in capital gains tax. There may also be a Medicare surcharge tax, depending on your income as well. I'm not an accountant, so don't consider this tax advice. This is just to give you an idea. If you're going to sell a home, you could do a back of the napkin sketch of how much you might owe in capital gains tax on selling that house. Of course, check with your CPA to get a more accurate estimate. I hope this was helpful. Have a great day.